How to buy a new home after a divorce. And divorce doesn't just change your life, it reshapes your finances, your credit, and your path to home ownership. And the good news is that you can absolutely buy a home again if you structure it the right way. And as a mortgage broker, I'll tell you this up front, this is not just about getting deals approved, it's about setting yourself up to win long term. Step number one, understand your financial reset. And after a divorce, your financial profile changes immediately. Your income may be reduced as a single household now. Your debt obligations may shift, and assets may be divided, but also credit scores can fluctuate as a result. So, the key insight there is the lenders are not looking at your past, they're underwriting your current stability and your future ability to repay. Step number two, know what income counts. One of the biggest questions is, can I use alimony or child support to qualify? And the answer is yes, but with a few conditions. They must be documented in your divorce decree and must be received consistently, typically 6+ months, but also must continue for at least 3 years. So the pro tip there is that structure matters. And if your divorce agreement isn't written properly, you could lose qualifying income. Step number three is clean up the mortgage liability. So if you were on a previous mortgage with your ex, you may still be legally liable for that debt, and it can impact your debt to income or DTI ratio. So, some solutions can include refinancing the property into just one spouse's name, or selling the home, or providing proof that the other party has consistently made payments. And generally, you need to see a minimum of 12 payments made from their accounts. And that is one of the biggest deal killers if not handled correctly. Step number four is rebuild and stabilize your credit. So, divorce can temporarily damage credit. And if you missed payments during the transition, or if joint accounts weren't closed out properly, or if there's increased credit utilization as a reduction of income, those are all common symptoms. But the target benchmarks you need to look for. So 620 plus credit score is an FHA loan eligibility, even as low as 580. 680 is better with conventional options, and at 720 plus, you're top tier. And even small improvements can significantly impact your approval and the rate that you get. Step number five is choose the right loan program. And after a divorce, flexibility is everything. And here are some strong options to consider. FHA loans. Why? Because they have lower credit requirements and higher DTI flexibility, and they're ideal for rebuilding borrowers. But also conventional loans, there's better long-term cost structure in them, and it's a strong option if your credit is solid. There's also bank statement loans for self-employed folks, and that allows you to use deposits instead of W-2 income, and ideal if income structure has changed post your divorce. There's also VA loans if you're eligible veterans. And there's zero down payments with flexible underwriting. Step number six is plan your down payment strategy. And most borrowers assume they need 20% down, but that's just not the case. So options can include 3 to 5% down for conventional, 3.5% down for FHA, 0% down for VA or USDA, and there's grant programs too that you can consider as a first-time buyer. And if you've received a settlement, those funds can often be used as a down payment, as long as we can document it properly. Step number seven, think like a lender and not just a buyer. And here's the difference between getting approved and building wealth. Some things that lenders care about are stability, your documentation, and the risk. So smart borrowers focus on the things that they can control, like making sure your payment's comfortable, make sure you have flexibility for your future, and also make sure you know your exit strategy for down the road. Your mortgage structure matters more than your rate does. Step number eight, timing the market versus timing your life. And a common mistake is waiting for the perfect time. And the reality is that rates can fluctuate and home prices move and life keeps going. So the right time to buy is when your financial structure is solid and not when headlines say it is. So, final thought on this topic. Divorce is a reset and not a setback. Uh, with the right strategy, you can rebuild stronger, smarter, and more intentional with your next home purchase. And if you approach this like a lender would, with focus on structure, stability, and long term positioning, you don't just buy a home, you rebuild your foundation. And that's a great starting point. My name is Bill Rapp. I'd love to talk to you about your specific situation. You can visit my website, billrapponline.com, to figure out how to get a hold of me and schedule a call. Love to talk to you further. Have a good day.